Good day, everyone. For today's presentation, we were going to discuss about the bonds payable. But before that, I will discuss first the financial instrument since bonds payable is part of it, specifically in financial liability. So the question is, what is financial instrument? Financial instrument is a contract that gives rise to what financial asset of one entity or an equity instrument or financial liability of another entity. So as you can see in our presentation, financial instrument is subdivided by financial asset, equity instrument, and financial liability. So financial assets is referred to a liquid asset that gets its value from contractual right or ownership claim. While for equity instrument, it is any contract that evidences a residual interest in the asset of the entity after deducting all of its liabilities. And the last is the financial liability. It is referred to any liability that is a contractual obligation, either to deliver cash or either financial asset to another entity and to exchange financial instruments in another entity under conditions that are potentially unfavorable.
So the next one is bonds payable definition of terms. So when you say bonds, it is similar to notes and loans, but on the other hand, it is a fixed obligation to pay that is issued by a corporation or government entity to investors. Next is debt instrument. So it is a tool an entity can utilize to raise capital. And then bond indenture. It is the contract associated with a bond where it includes a description of the bond features, restrictions placed on the issuer, and the actions that will be triggered if the issuer fails to make timely payments.
Let's move on to the measurement of bonds payable. According to PFRS 9, paragraph 5.1.1, the initial measurement of bonds payable is designated at fair value through profit or loss, or not designated at fair value through profit or loss. In designated fair value through profit or loss, it shall be measured at fair value of the bonds. The fair value is the same as the issue price or net proceeds from issue of the bonds. And the bond issue costs are treated as expense immediately. On the other side, bonds payable not designated at fair value through profit or loss shall be measured at fair value minus transaction costs that are directly attributable to the issue of the bonds payable. Moreover, the fair value of the bonds payable is equal to the present value of the future cash payments to settle the bonds liability. Bond issue costs shall be deducted from the fair value or issue price of the bonds payable in measuring initially the bonds payable. Consequently, according to PFRS 9, paragraph 5.3.1, bonds shall be measured either amortized cost or fair value through profit or loss. When bonds payable are measured at amortized cost, there should be a discount or premium amortization. Then, bond issue cost must be lumped with a discount on bonds payable and netted against the premium on bonds payable. An interest expense shall be amortized using effective interest method. On the other hand, fair value through profit or loss, there is no discount and premium amortization. The bond issue cost is expensed immediately. Interest expense is recognized using nominal rate or stated rate. Next is the fair value changes. If it is held for trading, it should be recognized through profit or loss. If fair value option is attributable, it should be recognized to other comprehensive income. If it is residual or not attributable to credit risk, it shall be recognized through profit or loss.
So a financial liability is recognized when it is extinguished, when the obligation is discharged or canceled or expires. So a financial liability is extinguished with the debtor either, according to PFRS 9, paragraph 3.3.1, discharges the liability or part of it by paying the creditor normally with cash, other financial assets, goods or services, or is legally released from primary responsibility for the liability or part of it, either by process of law or by the creditor.
Offsetting in accounting means reducing the balance of another account that is paired with. It specifies that a financial asset and financial liability should be offset and the net amount reported which has a legally enforceable right to set off the amounts and intends to settle on a net basis or to realize the asset and settle the liability simultaneously. Classification as liability or equity. A financial instrument is an equity instrument only if the instrument includes no contractual obligation to deliver cash, either a non-derivative or a derivative. If an entity issues preferences shares that pay a fixed rate of dividend and that have a mandatory redemption feature at a future date, the substance is that they are a contractual obligation to deliver cash should be recognized as liability. Compound financial instrument. Compound financial instruments have both a liability and an equity component from the issuer's perspective. In that case, it is required that the component parts be accounted for and presented separately. The split is made at issuance and not revised for subsequent changes in market interest rates shares. And that would be all. Thank you.